The public accounting profession environment. The practice of public accountancy was already introduced in the previous discussion, and I believe that there is no need to discuss in detail the requirements to enter the accountancy profession, as it is presumed that you know this already, as you are all future professional accountants. So let us start with the regulatory and professional organizations that influence the accountancy profession. For the regulatory government agencies, we have first the Professional Regulation Commission. So PRC administers, implements, and enforces the regulatory policies of the national government with respect to the regulation and licensing of the various professions under its jurisdiction, including the maintenance of professional standards and ethics, and the enforcement of the rules and regulations relative thereto. Professional Regulatory Board of Accountancy. As a licensing agency of the government, the board is the only body that may issue and revoke CPA certificates and grant licenses to practice. Its functions are provided for in the Philippine Accountancy Act of 2004. So it consists of a chairman and 6 members. Securities and Exchange Commission. So this is the government agency that regulates the registration and operations of corporations, partnership, and other forms of association in the Philippines. Commission on Audit. So this is the agency that audits or determines whether the government unit handle their funds according to existing laws and whether their program are being conducted efficiently and economically. We have the Bureau of Internal Revenue, which is responsible for the enforcement of the tax laws, rules, and regulations. So its agents conduct compliance audits, examines and reviews income tax returns of individuals and corporations to determine that income has been computed and taxes paid as required with the National Internal Revenue Code. For the professional organizations, we first have the Philippine Institute of Certified Public Accountants. So the PICPA is the accredited national professional organization of CPAs. It serves all its members in different sectors of the accountancy or of the accounting profession, namely the public practice, education, government, and commerce and industry through a set of technical social services. So it publishes the Accountants Journal that contains technical and formal papers, bulletins, and pronouncements released by the Financial Reporting Standard Council or the FRSC and the Auditing and Assurance Standards Council or the AASC. And we also have sectoral organizations. So these sectoral organizations complement the PICPA's objectives and provide the specific professional development and other requirements of CPAs in the different sectors. And they are as follows. The ACPAP or the Association of CPAs in Public Practice, NACPA-E or the National Association of CPAs in Education, ACPA-C, the Association of CPAs in Commerce and Industry, and GACPA, the Government Associations of CPAs. For the standard setting bodies, we first have the International Federation of Accountants. So IFAC is a non-profit, non-governmental, non-political international organization of accountancy bodies, and it has its mission, which is the development and enhancement of the profession to enable it to provide services of consistently high quality in the public interest. International Accounting Standards Board. So the board is committed to developing in the public interest a single set of high quality global accounting standards that require transparent and comparable information in general purpose financial statements. Financial Reporting Standards Council or the FRSC. So the Financial Reporting Standards Council is tasked to assist the board in carrying out its powers and functions, particularly the adoption of the International Reporting Standard in the Philippines or the IFRS. International Auditing Practices Committee or the IAPC. So IAPC is a standing committee of the Council of IPAC, and it is responsible for the development and issuance on behalf of the Council, standards and statements on a variety of audit and attest functions in order to improve the degree of uniformity of auditing practices and related services throughout the world. So IAPC issues the international standards on auditing that are applied in the audit of financial statements, audit of other information, and related services. Lastly, we have the Auditing and Assurance Standards Council, or the AASC. So the Auditing and Assurance Standard Council is the body that is assigned to assist the board in carrying out its powers and functions, particularly the adoption of auditing and assurance standards in the Philippines. So those are the regulatory and professional organizations that influence the accountancy profession. Let us proceed to the CPA's legal liability. So the standard of care applicable to the conduct of audits by public accountants is the same as that applied to doctors, lawyers, architects, engineers, and others furnishing skilled services for compensation, and that standard requires reasonable care and competence therein. So potential litigation is a major concern to auditors. So there may be cases wherein negligence or breach of express and implied contracts with clients results to liability of auditors, which came from failure to provide services or from not being able to exercise due care in performance. Lawsuits typically involve alleged misstatements that auditors did not detect in the financial statements. So these misstatements are usually improper or inadequate disclosure or inappropriate valuation. So CPAs must perform the obligation that they have agreed to do under a contract and that they claim have been done in order to make sure or in order to make the determination set forth and presented in their report. So they cannot escape liability for negligence by a general statement they disclaim is reliability. So we have here example of possible entities that may sue an auditor and the possible reason for their lawsuit. So a client may sue an auditor for breach of contract due to non-performance of stated terms in the engagement letter, which can be a valid reason for legal action. Third-party users naman may sue an auditor for reason of negligence, having failed to use due care and failing to identify material misstatement. Government, on the other hand, may sue an auditor for fraud or gross negligence after the auditor has knowingly issued an incorrect audited financial statements or incorrect audit report. So to further understand how and when auditors can be liable, we have the following legal concepts related to auditors' liability. Starting with due professional care. Auditors are not infallible. Ibig sabihin, auditors can make errors in judgment. But auditors are expected to exercise the same reasonable care with which others in the profession would perform in similar circumstances. So this is frequently referred to as exercising due professional care. So the standard of due care to which the auditor is expected to be held is often referred to as the prudent person concept. So it generally implies four things. First, the auditor must possess the requisite skills to evaluate accounting entries. Second, the auditor has a duty to employ such skill and with reasonable care and diligence. Third, the auditor undertakes his tasks with good faith and integrity. But again, auditors are not infallible. Lastly, the auditor may be liable for negligence, bad faith, or dishonesty, but the auditor cannot be held liable for mere errors in judgment. So where does the auditor's legal responsibility arises? So the sources of auditors' legal responsibilities to others are established by either common law, which are the laws that have been developed through court decisions rather than through government statutes. An example of which is an auditor's liability to a bank related to the auditor's failure to discover material misstatements in financial statements that were relied on in issuing a loan. And a second are the statutory laws, which refer to the body of laws passed by legislative bodies such as Congress. For example, auditors for an entity selling securities under Securities Act owe a statutory duty to a purchaser of those securities. As mentioned earlier, auditors may be liable but not for mere judgment or for mere errors in judgment. So let us discuss the auditor's degree of wrongdoing, or the degree of auditor's failure to fulfill their responsibilities. So at one extreme, auditors may perform an appropriate audit and issue an appropriate report. Hence, dito ang auditor, they have no degree of wrongdoing because the audit was conducted appropriately. On the other extreme naman, auditors may commit fraud because they know that the financial statements are misstated, but they do not take appropriate action to report the misstatements. So the court considers fraud as the maximum wrong that auditors can do. In between naman ng dalawa, the court have identified two degrees of auditors' wrongdoing, which are negligence or ordinary negligence and gross negligence. So when we say ordinary negligence, this implies absence of reasonable care that can be expected of a person in a set of circumstances. So kailan ba masasabi na negligent ang isang auditor? So auditors are guilty of ordinary negligence if they do not do what reasonably prudent auditors should do in the circumstances. And one result of this wrongdoing is the failure to identify material misstatement. So the failure of the auditor to identify material misstatement is one example of ordinary negligence. On the other hand, auditors are guilty of gross negligence if they consistently fail to follow the standards of profession on an engagement. Ibig sabihin, hindi nila pina-follow yung standards on auditing. So given that CPAs are obliged to exercise due professional care during the engagement, so ano ba ang auditor's liability once that there was a failure in an audit? And what can the auditors do to defend themselves against legal lawsuits? Let us start first with auditor to client. So for the auditor's liability to client, failure by the CPA or by the auditor to exercise degree of care may constitute negligence and breach of contract to render professional service. So in the event the auditor is found negligent, a client is entitled to recover any losses to which the auditor's negligence was proximate cause. So the client may also recover, in addition, the audit fee because of the auditor's breach of contract. So ano ang pwedeng gawin ng auditor once that they are subjected to lawsuit by the clients? So under common law, CPA firms can use one or a combination of the 5 defenses when there are legal claims by clients. So these are: first, the CPA firm can claim that there was no implied or express contact to perform the service, and this is referred to as the lack of duty to perform the service. Second, the auditor may say that the audit was performed using reasonable care, or the lack of reasonable care did not cause damages. Third, the reliance on the financial statement did not cause any loss. This is also referred to as the absence of causal connection. Fourth, in cases in which a tort is involved, auditors in some jurisdiction can claim contributory negligence. So this means that the client's own actions contributed to the loss. Lastly, the auditors may claim that the statute of limitations on the action has expired. As to third-party users, since third-party users like creditors and investors rely upon the auditor's work when attest to the financial statements, auditors are liable to all foreseeable third parties for losses which are caused by the auditor's fraud or negligence. The auditor's defense against third-party losses naman will be the following. So the auditor have 4 defenses which can be used in combination. First, the preferred defense in third-party suits is what we call non-negligent performance. So if the audit was conducted in accordance with the standards of auditing, the other defenses are unnecessary. So ito yung pinaka-preferred na defense, that the audit was in accordance, or the audit was conducted in accordance with the standards of auditing. Second defense naman is the lack of duty defense, which is the defense that contains lack of privity of contract. So ano ba yung sinasabi natin na privity of contract? Privity of contract means the limitations of liability to the parties to a given contract. Under privity, the CPA is not liable to third parties for negligence. Third is the absence of causal connection. This means the third party must be able to prove that there is a close causal connection between the auditor's breach of standard of due care and the damages suffered by the third party. So this could also be construed as non-reliance on the financial statements by user. And lastly, the auditor can use the statute of limitations defense, which is the statute of limitations on the action has expired. So kung mapapansin, ang wala sa defense ng auditors against third parties is the defense of contributory negligence. So this is ordinary, the contributory negligence is ordinarily not available in third-party lawsuits because the third party is not in position to contribute to misstated financial statements. So given that auditors may be subjected to legal liabilities, how can exposure to these legal liabilities be minimized? So in light of the auditor's extensive exposure to obligation, public accounting firms must take positive action to withstand the threat of legal liability. So among these actions are: Number 6, use engagement letters which clearly point out to the client the scope of the auditor's services and responsibilities in a particular engagement. Later on, you will learn how to make an engagement letter. Number 7, conduct the audit with appropriate professional skepticism. Number 8, provide the opportunity for auditor to consult with more experienced auditors about difficult issues. Number 9, maintain adequate professional liability insurance coverage. However, this is not a common practice in the Philippines. And number 10, seek legal counsel whenever serious problems occur. So to end, it is important to remember that while auditors have important responsibilities, the management of the entity or of the client is primarily responsible for maintaining effective internal control and for ensuring that the financial statements are fair.